Damn. You know, I didn't do this on the live stream, but I did record this the entire time. So sit back, relax. We got Powell coming on in about an hour, 45 minutes, 30 minutes. I think they're going to release something at 1, so in about 15 minutes. Let's chill. I'm making a short right now, so just give me a minute. It's going to be silent for a minute. I'll try to talk. I got this thing running. Damn, dude. I was trying to buy VWAP, and then I bought the lower portion, and I was going to ladder out, and it just shot up, and I was like, oh. Okay. Well, anyways, I got it on recording, and I'm going to put that out later once I get it all together. Right now, I'm trying to make a YouTube short with this trade. Well, I am on speakers, or voice, if you guys want to talk. All right, got that YouTube short rendering. Welcome, welcome. Set it the title here. I haven't been watching this trade. Oh man, kind of want to take this. You know what? Even though it's gonna probably go up, I'm gonna pull this because I want to take the money. And that was a damn good trade. We have a red dot appearing here. I have a YouTube short about this whole trade, and I have a recording too, so that we can, you know, show it. So once that's done rendering, I will upload. It's done. Okay, so I'm gonna upload that YouTube short here in a second. We're hanging out for a minute. I think we got something coming out in like 5 minutes or something. Hold on, let me figure all this out. I am doing more trades. Just hang out. We're gonna wait until Powell speaks because this is gonna be freaking bumpy. All right, now just gotta do a photo and that thing's still running. Here we go. I think something's coming out in like 1 minute.
And get ready once it comes out. 30 seconds. Then just keep refreshing this till it shows up. I'm not even going to read the statement. I'm going straight to the terminal and everything else. Maybe they do leak it again. 20 seconds. Yalla. 10 seconds.
Oh, God.
See you. No, not nervous. I'm excited. This is fun. This is fun. Oh, big drop already.
Dude, what the fuck? Why didn't my orders fill?
Longer run median Fed funds rate at 2.5. Oh, 5.1 in 2023. 4.1 in 2024. Shit. So it's a little bit higher there, but let's see. Watch for the first move. It's higher enough. Interesting. Let me check here. Yeah, 5.1. Nah. All right, we got that one.
So should I just cancel my
orders? What is that? 404 to 402. It's only 2 points. All right, went one short on the NASDAQ, but I'm holding my ES. Oh, they already scammed me on that one. I already bottom ticked it. Hold on. Watch out for a bounce. If that's already moving up, they got me on both now. But hold on. 5.1 is a little high. Again, 5.0, that means they're 50 basis points off. I think it opens up the door for 50 pretty much. So I don't think we're as close to 25 yet. They downshift to half a basis point. Ongoing increase is seen. So
this is why I think like sometimes they scam you. And this is why you don't leave orders.
So that's good and bad. But then
it's like, did I get filled or what's going on here?
That's kind of more
if I got filled, I'd like to get the fuck out. You know, like.
Saying, kind of to the contrary.
But we'll see.
I'm balancing them both out yet, but the press conference will be bigger. We need to see how he explains it. So this time around, it's a little bit more bearish on the statement.
Yeah.
And then it may open him up for a more bullish conversation, but that's it. All I'm going off of is the 5.1.
I would like to,
the median, Oh, wow. They all agreed. They all agreed 5, and then not too many people were lower. There's only 2 people that were below. And then there's some people at 5.5. So whether that's Powell and Bullard, maybe.
So what are we doing here?
It could be Powell and Bullard there.
I think.
So let's see. You're making another move down here. And the bonds haven't moved too big yet in a weird way.
It's like a Forex scam. Damn, we're going to lose the profits today.
But the bonds should die on there, so be careful.
It's like what Forex does.
Let me see. Again, they pair gains after that.
Come on.
Yeah, I'm down 4 on that one, so I already made 1,000 back there.
How the fuck is it going to take this long to get out?
I'm silent at 400. I closed the ES, 4,000 loss from yesterday, but then we have 1,000 on NASDAQ already.
It's got to not be filled. Hold on.
But then I'm holding the shares.
Fucking scammers.
It could still change. I think you'll get a bounce here. They might have just flushed me out of it. I think his press conference, he might be a little bit more bullish here, but this is the problem is this, the economic projections now mixed in with 5.1. Again, like we were saying, 5.1 isn't going to be pretty. So Treasury market is selling off. I'm still going to hold the bonds.
It says it was a $7,000 loss. Okay, so I don't.
So there's your bounce here. They may have got me flushed out, but we'll see.
6,900.
Now I'm only at like 300 on the NASDAQ.
So we took a 13.6 profit and then had a 6,900 loss on that drop. That was fucking scary.
Basis points to get to 25, which is the new 5.1.
Okay, so I mean we're still in profit.
Is selling off with FOMC statement.
6,900.
Not a single dissent.
Hold on, calculate that.
Unanimous vote came in February.
I thought I lost all the gains for the day. I was like, damn it.
Perhaps not even raised at all. percentage point worth of rate cuts penciled in for
6,100.
Looking at the
What is
median
going
rate
on here?
cut.
Sell.
Oh shit, where did it go?
I swear to God, if it puts me in a fucking order.
Yeah, so they see
Did
2024
short,
they
did it?
expect rate cuts, but that's already different. Again, they got me on the other one. I may want to get back into the ES. I just don't want to get hustled. But watch out. Again, we barely moved.
No,
though. This is
I
only
see it.
4 points
Yeah,
now.
it just put me in a
Last
fucking
time we moved
short.
8, and this is slightly of a shocker. But let's see if it can hold up. You're gonna get a monster.
Okay, but it's in
I'm still
profit.
gonna hold the short though, and then I'm gonna look to add probably in a little bit or until we see. I want to get a little bit more out of Powell. Oh shit! I forgot. We got that one put right.
This is why you don't trade these
That one
fucking
barely moved
Fed
back. That's
moves.
the funny part.
Because they
Now
get the
you're
priority
bouncing
and
up.
they get to scam you. Okay, so it closed out. Okay, that was only a $300 loss. That's really odd.
416.
Alright, so hopefully there's no orders or nothing going on that it's gonna somehow buy again, right?
No, that's not holding. If you get one more drop, there'll be another opportunity. Yeah, but the
Dude,
difference
that's
is
so
the whole dot
fucking
plot is just different than what
stupid.
the market was pricing in. So that means the Fed
Okay,
is
so we
saying
had
we're
a
gonna cut later,
$7,100 loss.
just about
So from
another half a point
13.6,
higher, or even like a quarter. I mean, pretty much 5.2,
13,600
and obviously that could be changed.
minus
Now, how he works
7,100.
it makes it a little bit more
So
difficult,
6,500
but
profit
that
on the
wasn't
day.
expected
Let me
after-
change
I
my
mean, I would
YouTube.
argue after that CPI, I'm not really. That's kind of like really bad if you think about it, because putting it in context, you just now this. It's as if they didn't see the CPI because pretty much CPI didn't change anything for Powell now. That's what I'm getting just off of the text there.
All right. And then now we're going to let it cool off for a minute. We're going to wait for Powell to talk maybe before I get in a trade. I want this fucking scam shit to stop. This looks like a bottom, but you never know. Right now, it could seem like it is, but it's not.
December 14th? Fuck me. Oh, damn it.
I'm going to do the
I wanted December
YouTube short real
16th.
quick.
I bought a December 14th SPY call just in case on a daily. So not a recommendation. You'll lose money. Again, because I took a call or a future for a loss, and then I have one of the shorts. But no, dude, I went on a daily. Well, shit, if it goes up, I'll get hooked up. If not. And again, here's the fun fact. The put I got in the morning, it didn't work. It didn't. So even then, off of this 4-point drop, my weekly option came back to break even. So I don't even think that hedge will work. So I'm either going to just get lucky if it gets a monster pop, but I think this is just boiling down. We got to wait for what's his name. You got to wait for Powell. I'm surprised. If it wants to bounce up, God bless, but it's somewhat of a small move. It looks like Ira Jersey was right. This isn't that bad of a move. You're below the 200-day, but where you go from here is not that. Isn't that bad. That's why I'm like, okay, Powell's statement is going to have a lot. Powell has a trick up his sleeve here because this isn't. I mean, again, this is kind of surprising. And then now most of them, looking at the dot plot, most of these mother effers were at 5, which was what we all expected. But you had a lot of people way higher, and it's not as if this is skewed by a couple of people. It's like you got to realize. It's like they totally ignored it. They totally ignored it. No, he doesn't. He might, man. Now the put's going up. Now the SPY put has gone up 50%. So maybe that hedge might work a little bit. Little scammers. And then now it's 08. Watch 15 minutes, my friends. So give it a couple more minutes, and then we're going to go from here and see. No, Powell, I don't know, man. That's it. I mean, the summary of economic and then unemployment, it just shows that they expect more pain, but then they're not going to change their rate hike trajectory, which is very, very phenomenal here. So let's see how this plays. The bonds are getting clapped. XLU still holding. Okay, that's a little bit of a bigger drop there now. trust the Fed. Where were we? Let me check SPX. So give it a couple more. You're breaking levels now. No respect. No respect, my friends. What time? 9 minutes. So give it 15 minutes and see where it's at. That was just into the low. Option premiums jumped 10% on that move. Again, the puts actually went up finally. But we'll see. We're not out of it. Powell's going to be a shit show. Excuse me. There's a percentage point worth of cuts penciled in 2024 looking at the median. Recall in September, the median was barely 4.6. This move in consensus is good news for Powell and likely dispel concerns about dovish members. Yeah, bro, it's like everybody on the Fed just got dramatically more hawkish in unison. So we'll see. We had a unanimous vote today. That's clear. There's clearly a whole lot of division over expectations in 2023, with 7 of the 19 seeing a policy above 5.25. That's a sizable minority, and that is much more hawkish tilt than overall universe of private sector economists. Only 5 of 65 forecasters were expecting to see this right here. So we will see. Give it a second. Give it 5 more minutes, and we'll see. If you hold up, this will be the trend into it. Now it's getting a big drop, a tiny bit, but we need this to develop. Give it a couple more minutes. The 5.1 is pretty solid. We have 10 and 19 at 5.1 and just 2 below it. The other 7 are above it. Split between 5 and 5 and 4 and 2 at 5.6. These are the 650th basis point in the last 30 years. Alrighty. $11.11. Okay, let me check where we're at. All right, 3996. This is another level. Where does this take us? So look at this is back to the Powell dump level. So if you don't hold from here, this is we may want to hold here till Powell's conference. So I wouldn't be surprised there. And then as Powell speaks, we go from here. Otherwise, he just needs to dump it. But again, it seems like a hawkish tilt so far, and I'm very surprised. Ira Jersey says hawkish statement takes back some of Powell's perceived dovishness. This was not surprising. We think it suggests the recent steepening of the yield curve could once again head towards a new cyclical lows before year end. However, I think the market will be cautious before the press conference, where in recent quarters the rates market has seen the bulk of the Fed day moves. Treasury sell-offs picking up. Markets are now in the red still. Puts are up, calls are down so far. This again, we need a first bounce here, so we're going to find out. What do we? I think we got 4 more points to move. All right, back to 4. How are you respecting the levels there? So again, that's a big bounce there. That's borderline vertical right there. Come on, load. Damn, I missed out. So one of the calls there, that was a good bottom there. But now give it 3 more minutes, and then we'll find out. We might base out till then. Volume's actually not as high. You would think the VWAP would drop more. It's definitely elevated, but we'll see. And then that's holding there from the bottom. 40.02. Just watch the 47. It's the same shit as yesterday. Again, you actually fell through here by 10 points, and then we bounced up. But then we'll see Powell's the vibe leading into Powell. Bro, Bookmap is actually trippy. It's not even that crazy. You're coming up a little bit. Still up on the options now on the put, and then the call's going up. Still up on the NASDAQ. I took the loss on the ES. Always wrong. Well, again, this is like, what's it called? This was like September. Then you had your bounce, then you came back down, and then as the press conference began, we started to go up here. So let's see. I didn't even read the statement, dude. So I'm not even checking this. I'm just looking literally at the SEP. Hawkish revisions to inflation, with the majority of FOMC seeing core PCE decelerating to 3.5 versus 3.1 September forecast around. So it's kind of looking a lot like September here. So I'd wait now. What is it? 11:14. You're holding the first drop level 15 minutes in. I don't think we need to read this statement. I don't think it means anything right now. This is enough. At the end of the day, the Fed is expecting more unemployment, and then they're still expecting a higher rate. And the market's about 0.5%, 75 basis points off. That means the market is still 1 or 2 meetings away from where they were pricing in rate cuts or anything. And then given that most people are agreeing on the Fed, it seems like they are pointing towards the direction of, they don't care. Again, even though the market's disagreeing, they're pushing it in there, man. So now premiums are in a very weird spot. Well, no, people aren't worried recession. The bonds will catch the bid if they are. But it's Powell's speech, dude. Powell's speech is going to be insane. That's what we need to be waiting for on here next. Looking at the median forecast, the jobless rate, Fed policymakers are basically predicting a recession at 0.5 gain for GDP in the fourth quarter next year compared with current. Could easily incorporate 2 or 3 quarters of contraction and the jobless rate rising by almost 1 percentage point. That's an outlook that is pretty consistent with recession. So that is what Bloomberg Economics just said. So Powell may still be hope for a soft landing, but basically that's what I said. They're basically projecting pain. And it's weird, but they're also saying higher rates now. It's very odd, bro. This is I want to say it's dramatically hawkish, but then again, if Powell comes in, he might be able to change this a little bit. So we'll see. Here's a forecast of employment and how they've shifted unemployment. At the end of this year, they've shifted among Fed. It's not a huge move, but it's indicative of the labor market persistent tightness. This is something that may start to creep more into discussions of 2023, especially if inflation continues to move down. What impact will this tightness have on the Fed's ability to get inflation above 2? All right, you're holding that 15 minutes solid right at the low of where we broke, and I believe this is right below the next level. Give it 15 more minutes to see the direction, and then honestly, I think reverse the direction as the press conference starts. That's it. So if we're down, if we drop into a new low, I think 15 minutes in as press conference begins, I think you might get a little bit of a reversal, but we'll see. Again, all of it just in the dot plot. Again, look at where they all are. See, 2024. They're more confused about 2024 of when to cut, but everybody's unanimous in terms of it seems like the Fed wants to cut in 2024, but that's it. It's crazy. All right, come down. Let's see. Oh, the dot plot's hidden. My bad. So, like, that's the weird part about this. Nah, it's good, Charlie. If anything, it's chill. Keep it low key. Keep it low key, baby. Tweet at YouTube and tell them to stop bandwidthing me, bro. That's what everybody need to do right now. Sorry if you've been having any technical difficulties. So look at this. They're not even worried about 2023, bro. Nobody is on the Fed. Two people on the Fed are assuming we're going to be a couple points higher than where we are at. Nobody on the Fed is saying rate cut in 2023, even after this inflation data, and that's where it's getting ugly. But then, again, the market has already been different. Bonds are moving a little bit here. So watch out. Again, market's barely down. It's just this is 405 to 400. Dollar is still red. Just watch out for it. I'm watching the clock. Just give it, dude, we have 12 more minutes. You're going to get a huge rip up or a huge rip down. And then as the speech starts, everyone's going to just turn on an algo and then ride whatever the momentum they're going to opposite of it. That's what I'm thinking. Again, it looks a lot like September when it's all said and done. So, again, this was September. You did the bounce. And then, again, you chilled. And then right as the speech started, you went the opposite of wherever you were. So new projections for the Fed, GDP, PCE, and jobs, unemployment seen hitting 4.6 in 2023. It was projected at 4.4, but then the rates, they want rates to go higher than it. The dot plot is on the Federal Reserve website under projection materials. They juiced the premiums off of that one. I was going to snag some calls just in case too. So I have both. I have one call, one put. I'm going to make the money both ways. But then I have the NASDAQ. I closed out of my ES, but they just messed up the premiums on that move. You could get the premiums a lot cheaper in 10 minutes, or they're going to be double the price in 10 minutes. That's the problem right now. So it's kind of a high-risk, high-reward environment you're in. But it's clear Powell, bro, it's all in Powell's. Head of macro, George Concalves, MUFG, says as close to recession call from the Fed I could ever recall from the SEP forecast while holding rates at multi-decade highs. This is a Fed that wants to make inflation is done and won't relent that quickly. Sell-off is realizing that we were wrong on the zip code on expectations. They're hiking and market still wasn't taking it seriously. He says that the clustering of the dots of 2023 above 5 with only 2 below that level show an FOMC on the same page. That's just what I just told you right now. The upshot, they're going until something breaks in the economy. Markets are both to get aggregate demand and reduce wages and cut off potential for wage price spiral. They're not taking any chances on how little it's changed from the prior meeting, says Neil Dutta. I disagree on that one. There's a mild recession they're forecasting. Diane Swank, chief economist at KPMG. Yeah, I agree with that. They're going to go until something breaks. That's it. The numbers, they don't even need to communicate it. Like, that's all this is said. Dude, they're not. Dude, what were they saying? Dude, what was Nick Timmerhouse even saying? Nick Timmerhouse was really wrong. Dude, there was no disagreement at all after 2 CPIs. Like, that's it. They all were saying 4.8. The lowest Fed expectation was where the market was already pricing, which is another quarter or half a point from here. Everything else, everybody is on the same page. But I agree with it. I just think they will tighten until it breaks. I don't even think Powell. I think soft landing is just for words, but Powell wants to. That's it. So we'll find out. Jeez, man. Okay, so premiums dropping a little bit. Watch for this drop. If it doesn't fully flush, you'll have some protection. Again, you've seen how you played out at this level as of yesterday. But we'll find out. It's 11:21, 9 minutes till the speech. Apple and Tesla were the leaders on the NASDAQ there. Let's see. If it goes a little lower, that'd be nice, but be on the lookout. Dude, this is... I could only imagine what Powell's about to say right now. That's it. I mean, he's going to either try to ease us down or he's going to just drive it home. Very, very bearish right now. But there's a lot of questions. There's going to be great questions from this, my friends. How much? Well, the projections didn't change too much. It's like how it's changed. So the unemployment's only up by 0.2, but then now the rates have gone up another half a basis point. And then, the statement itself was exactly the same, but, like, there's no disagreement. The only thing they're worried, they're saying we're going to cut in 2024. The bond market is way off. That's all it is right now. The bond market is far, far, far from what this is saying. Any messaging you've got from the Fed, any CPI coming in good, they don't give a shit. Excuse me. But that is the market has uncertainty, but not the Fed, bro. Look at this. The lowest expectation is 4.8. for the end of next year. So that means they are all projecting after making a decision yesterday and seeing the CPI. They are still under the impression that we will be raising at least another 50 basis points, potentially 75 in the next 12 months. But then we're going to stay there and one person, look at 4 or 5 people are still saying they won't even cut. And then you got a decent majority saying we'll cut by the end of next year. But that one's a little bit different there if you really think about it, man. That one is crazy. So, yeah, I don't know. That one's not the brightest right there, man. Then 11.23. A little drop in. Wants to die here, but watch out. It doesn't have to fully die like last time. And then this is going to be 3.997. They want more people. They know this would imply the bond market's selling. But that why I'm holding the bonds, because they're pricing in a recession. Now I'm like, hold on here. So let's see how this plays out. But nah, this one's wicked, bro. This one's wicked. So the puts are calming down a little bit. Yeah, just wait till he speaks. I mean, you could try to front run ahead, but Powell is going to create a nightmare. And then we have, what, 5 more minutes? Let me see the ES. Let me get up the Fed. Where's the press conference? There it is. Banger. Okay. I went long on the ES, still on the short. Again, now you're entering the 5 more minutes into the conference. There's still the put, though. I'm still in that. I'm still going to be in that one. And we're going to ride that one out. And then I'm going to plan to sell out after we get a run up on the ES. Not a recommendation. You'll lose money. And then get ready. We're about to start. Oh, 15-minute dump. We still got 4 more minutes. So let's see. Again, my plan would be if we get a run up, I think you're going to get some sort of run during the conference, and I'm going to sell out that ES, and then the plan would be to add to even another put there. Otherwise, we'll see. I could get double clapped. I've already been clapped here today on that, but I sold out a little bit of the gap here. I'm expecting run up in the conference now and then dump after the right question. Or, again, it could even run up there. I think you're going to get some level of pop here today, but we need it's going to be big, so we're going to have to see. Where's the press conference? There it is. I have the little one, but I don't want it to be like too bad, you know what I'm saying? Dude, you're right at 4. This is going to be massive. Bro, you're right at the level right now. This is it. I can only, again, look at their computers are just keeping it pinned. There's one big sell order. They're just going to have to make, they're going to eat the 40-45s. Just like yesterday. It's going to be very hard to play, but it's, again, listen up, because whenever it happens, you're going to get the next move, and it will be fire. Again, if we get the right question, the right answer, this should be an easy read, but you know it has a hawkish tilt. Again, if he eases the pressure, then you're going to get your upside. If he doesn't ease the pressure, then there you go. I'm going to keep that up. I didn't know you could get that. I could get a live text to that. Interesting. Again, we'll have this one up. Conference starts in about 2 minutes. Banger. And you'll see the bonds. you guys gonna need to see him, man. There you go. I'll make it a little bit smaller. Come on, pal. There you go. Perfect. To get some audio and get ready. I'm keeping up the captions just in case. I think that would be interesting. Dude, that's crazy. Bro, it's 5. Bro, nobody on the Fed. What have they all been saying? Even Timmerhouse. I'm very disappointed in Timmerhouse. Timmerhouse wasn't even close. That's it. And then, dude, do you realize they are not, based on what I'm reading here, we're going to see, someone's going to ask him about inflation, and hopefully he says something dovish. Otherwise, dude, they're acting as if inflation has not even moved. Like, look at it. So, right, they still haven't ate this order yet. You're getting a little more volatile. 1 more minute, man. No, but, like, dude, they're acting as if there's no mention of inflation even coming down. They've even raised their PCE and even core CPI expectations higher there. So you're dumping into it. Yikes. We have not had a dump into this. That's what makes this one a little more interesting. So fade out the music. Let's go. All right, how many seconds? Powell is live. He's not up there yet. Again, he usually gets up there immediately. He late? Yeah, he's late. Again, how much seconds? The latest he's been is 15 seconds, or I think he took 30 before. And that was in September. September he came out late again. He's live on, is he live on C? I don't know. I'm not getting it. There he is. Okay. 1 minute to start. That's a little longer. So there's, look, it's popping at the presser.
Good afternoon.
Hi.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year.
So even if you think the stream
Recent
is lagged,
indicators
this is
point
why
to
I have
modest
this up
growth
here.
of spending and
This is straight
production
from
this
the Fed
quarter.
site, the captions.
Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates.
Market doesn't
Higher
like him
interest
talking
rates and
about real
slower
estate.
output growth also appear to be weighing
Again,
on
this is
business
all in the
fixed
statement.
investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate.
That's the recession indicator.
Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low. job vacancies still very high, and wage growth elevated.
So strong jobs market's
Job
not
gains
good.
have been
Again,
robust.
this is
with
all in the
employment
statement,
rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier
Dumping
in the
now.
year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year.
Uh-oh, he's coughing.
Inflation remains well above our longer run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%.
Bro, this is off the statement.
Excluding the volatile
This is
food
crazy.
and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range
positive
of goods and
acknowledgement.
services.
But again, this is
Russia's
all in the
war
statement.
against Ukraine has boosted prices for energy and food
Get ready.
and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored,
I bought another
as
daily
reflected
spy
in a
call.
broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for
It's gonna
complacency.
be a fast trade,
The
so
longer the current bout of high inflation continues,
you know we
the
gotta
greater the
be
chance
safe on this. So
expectations of higher inflation will become entrenched.
we'll put a stop like right on it, and it's probably gonna get stopped out, but we might be able to get a banger from it.
Maximum employment and stable
$1,200
prices for
bucks.
the American people.
Not bad. Let's just watch. It's probably gonna get
Economists are
stopped though.
acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses.
The reason I took
to
that
both
there,
segments
that's
of
the
our economy,
monthly
and we are
spider
strongly
line.
committed to returning
And if you took the course, you would know how those are drawn.
Yeah, you are.
At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
That's your cumulative
In
tightening
light of the
worded
cumulative
differently.
tightening of monetary policy and the lags with which monetary policy affects
There you go.
economic
Again,
activity
it's all
and
pre-written
inflation,
though. This doesn't matter.
the committee decided
why
to
I'm
raise
shocked at
interest
this
rates by
move.
50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
I close my NQ.
Our decisions will depend on the
25
totality
profit.
of incoming
I'm
data
gonna
and their
reshort it. If it
implications
goes
for
down,
the
I'm
outlook
fucked.
for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to
Maybe to look at
demand
long
so
at the
that it
monthly.
becomes
I'm not going
a
to take it right now because I don't get fucked again.
Our overarching focus
But
is using our tools to
that could have been a
bring
good
inflation back
spot to
down
maybe
our
long
2%
once it
goal
broke through.
and to keep longer-term inflation expectations.
Let's just watch it.
anchored.
Because after he talks, we're going to get a
Inflation is
direction.
likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run.
It's very hawkish.
The historical
This is
record
just
cautions
weird that it's
strongly
dumping
against
during a
prematurely
pre-written
loosening
statement like this.
policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
10 minutes, 9 minutes.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place.
Awful first question.
Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%.
That's not a good question.
Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year.
Okay.
But our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for
he answered the same
our
question
current
last time,
assessment
but he didn't sound as bearish on that.
Will be. As you will have seen,
But he said the same exact thing.
19 people filled out the SEP this time, and
That could have been a lot worse.
17 of those 19 wrote down a peak rate of 5% or
But
more
watch,
in
the
fives.
candles are big.
So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent...
Notice that the money flow is starting to come bearish on the 5 minute.
Increased our
It did here
estimate
as
of what
well,
that
but
peak
oh,
rate will
this
be.
indicator's
So
not
that's
that
not
great
good.
with the
Talking
money
about
flow.
what we don't like.
The SEP that we're
Market cipher's the one to get, but you can see that we are
FOMC
entering bearish money
participants
flow.
believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate
I'm reopening up
of
the
what we
short
think
again.
that peak rate will be
I don't like
based
that.
on what we know. Obviously, if the inflation
I'm
data
going
come
2
in
of the
worse,
NASDAQs.
that could move up, and it could move down.
I don't like
if,
that. That's what he said
inflation data
last time. He just said he can
softer.
raise the terminal again.
So it looks like Stock Market Live just went short on NASDAQ. I'm waiting for this line right here to
SEC
break.
gets squeezed, though. I don't like shorting this low.
Like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments,
They
50
brushed
basis
that off,
point
though, 'cause
increments,
it's gonna
sort of
rip.
how you see the speed playing out going
Yep.
forward. And then I wonder what you're looking at as you determine when to stop.
As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw the how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised
Too soon. I already lost 3 on that
425
one.
basis points this year.
But at least we're making some of the calls
We're
back.
into restrictive territory. It's now not so important
wick.
how fast we go. It's far more
That was too
important to
early.
think what is the ultimate level, and then at a certain point, the question will become how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy, and that'll be the key thing. But I mean, but for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even
Yeah,
with
that's
today's
not good
move.
either.
And we've laid out our individual assessments of what we would need to do.
You said that
to
many
get there.
times before. Market might not brush it
At a
off.
certain point, though,
Again,
we'll
this-
get to that.
you just haven't had a
point,
rip today.
and then the question will
That's
be
what
how
I'm
long do
worried
we stay
about,
there?
but
And they're
restrictive, not restrictive is not
the
good.
strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into 3 sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half,
He's addressing
that
CPI
supply
now.
conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit, and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But
said
we
this
see that
last
the new
time,
leases
market liked it, but we'll
the rate
see.
for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
So you're saying services is the reason why they have a higher SEP and everybody agrees.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate
He might
or
bring up
modest, I
recession
believe.
question.
Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases.
Switching over to
none of that is guaranteed.
big
but
spider
that,
lines.
That is what their forecast reflects.
Give me a follow-up on that one.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell,
Okay,
I want to
watch
follow
out.
up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal,
bonds are
you
coming
would
back
feel
up
more
here, too.
comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline,
That sounds kind of
we
bullish.
think that the appropriate thing to do now is to move to a slower pace. And
He didn't knock down two.
that will
didn't
allow
knock
us to
down
feel
25.
our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes
it's
a
not
lot of
moving
sense,
it.
it seems to me.
Well, that's a good
particularly if you
question.
consider how far we've come.
Oh, you just said, does it make sense?
But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the
Hey,
state
he
of
kind of
financial
shot it.
conditions.
The fact he didn't shoot it down at first, that was the thing I like.
Come out last week. Do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants
you just
know
said
that
the
they have
inflation
they know
didn't
this,
even
that
affect
they
SEP.
can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Rachel?
That started off very bullish, but then it kind of just came back to
Hi,
neutral.
Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions.
Here's your girl.
I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just
not
that,
good.
by now,
Well, let's see.
we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where
Watch the bonds, watch the
4 million
10-year, though.
fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Yeah, he got out of rate, dude. He's been keeping it pretty neutral.
Colby
a lot
Smith
of it
with the
sounds the
Financial
same.
Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher
just hope the
than the
AP doesn't ask him a
5.1
stupid
medium
question.
estimate penciled in?
He's
Well,
keeping
I think
it
that's
fairly
why
neutral,
one of the
and he's
reasons it went up
defended
was that
against
core
the
came
other
in
one.
stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Victoria Guido, New York
Hi,
Times.
Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation's running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil
Dutta.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report.
Yeah,
it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
First entrenched question.
The data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation.
There it is.
As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
The orders are disappearing from the top here, but he's pretty much acting as if this is all expected.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So this is a soft landing one.
I think I got your question. So, one thing is to say is I think our policies are getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but
there's the
I think we're
run.
realistic about the broader project. So that's all.
Let's see if you can get
that's
to
the point I would
VWAP, or
make.
even
It's,
if you get up to
you know,
open.
we see goods prices coming down. We
This
understand
answer
what
is
will
gonna be
happen
key.
with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
That was hawkish towards the end, but the market's still going off of it.
No, I wouldn't say that. No, I don't say that. I mean, I would say this.
It's no longer achievable.
To the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist
Narrow,
in
soft
time,
landing.
could certainly make it more possible. So I don't think anyone knows
That's
whether we're
kind
going
of
to
bullish.
have a recession or not. And if we do,
He said
whether
soft.
it's going
He
to
said
be
the soft
a deep
landing's
one or
still in
not.
play.
It's not knowable.
But now he's talking
And,
recession.
Certainly,
That was a positive response.
lower inflation reports, were they to continue for a period of time,
The second
would-
part,
would
the
increase
first part
the
sounded
likelihood
hawkish, but he just
so
said
I would put it
the
this way,
soft landing.
of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan. Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
He said it is narrowly. Though.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough.
A lot of it sounds the same, but that's
in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people, and so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions, and I wish there were a completely painless way to restore price stability. There isn't, and this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Wasn't bad, dude. He says one
Mr.
hawkish,
Chair,
one
Grady
bullish.
Trimble with Fox Business.
I mean, we're still even trading
You've
pretty
reiterated
neutral.
today, and the
You're
committee
at
has
the
reiterated its
release
commitment
level.
to that 2% inflation target.
crazy.
I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Yeah, all the daily premiums been washed. I'm down on every single one of them. All the options are down.
Thank you, Chairman
Even
Powell.
then,
Nicole
it's been
DeCrunch,
difficult
CNN
here with the
Business.
futures. But
As you monitor wage
I have
growth
a good
and
plan.
unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult
Bonds to
than
the
we
long side.
can think it would happen
Still
here.
holding short
But
NASDAQ
it
and
really
one
set
ES
up our
positive.
economy for several decades of
But I think
prosperity.
that's
So
the
price
answer to this.
stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
They keep their eye on that. Thank you, Powell.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
Oh, stagflation question.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment.
Now you've hit VWAP
50-year
off
low
that.
in unemployment.
This is
Vacancies
big
are very
here. A
high.
lot of volume
Wages,
coming in.
nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
There's your rally. All righty.
Thank you, Chairman
Yeah,
Powell.
ES is
Greg
green
Robb
now.
from MarketWatch.
Everything, even the NASDAQ.
You
I'm getting
spoke a
clobbered
little
on the
bit ago. You
NASDAQ,
said
but
that
I'm still,
the U.S. looks,
I'm gonna end
it
up
looks like
holding
we
this
have a
one.
structural
And we're
labor
gonna ride this one for a
shortage in
little
the
bit.
economy. Could you expand on that, talk a little bit more about that? And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned,
the call premiums are coming back up
if you just
now.
look at demand for
So that's
labor,
actually
you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see. Despite very high wages and
premiums
incredibly tight labor market,
This
we
is
don't see
breaking it out. I think
participation
you're getting
moving up, which is
momentum. Even
contrary
watch
to what we
Apple in
thought.
the video,
So the
and then even the bonds,
upshot
too.
of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to a 500,000 who would have been working.
All three levels now. This is the 200 day.
And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks, Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean what we do is we make our forecasts. And we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't.
That's it. Call premiums have some here. If it doesn't rip up from here, it comes back down here by the end of the day.
Recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds.
I went too big on
at every
the
meeting, and we look at those
so
too.
I need this to
and those will
balance.
explore
It makes the
different
pain
things.
a little bit better.
That's just.
But then I'm thinking
upside
bonds,
and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, that we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of. For cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
There's no answers from anything. Very interesting. So right now, you have a shorter, you're still down from the report. This could get everybody riled. Bro, he answered everything. I'm taking dude, he just said, who cares what you price in? That's it. I don't think anything at the end of the day now, so we might be able to move here, but I think he was borderline just saying doesn't matter what you price. Who cares what the market's pricing in? He's saying, well, do you take into account CPI? So we expected it. We do this, we do that. He said, well, what if we literally, what was even that last question there? He's like, well, if we're confident, even the stagflation question, everything is there. I'm going to hold both ways. Like I'm thinking here, just again, I went short on the NASDAQ. I went a little bit big with size. I'm going to hold the ES again. So the daily's not too bad, but unfortunately, if I kept the other ES, it would have been good. But I'm leaning overall bearish, clearly. But then I think long bonds and then short NASDAQ. That's it. It's just that if it comes down, yeah. But either way, I think the bonds, the SEP, that got me. But then even his answers, he answered everything with a double-edged sword. That's it. Every single thing was a double-edged sword. And it was just, again, who cares what you price in? That's it. He's over. He just said, you had your inflation. I'll let you know if I'm confident. I will let you know if we're confident. So I don't know. I think it's volatile. I think the answer out of all of it is that, and that's why I'm saying, though, if the market, I'd rather go long on the 10-year and then short on the, short on the future, simply because if there is anything bad with the economy or if rates would calm down, bonds would have that benefit, or if people are worried, they'll buy it into there. But then again, you could still get squeezed. I think it's going to be extremely volatile. That's it. He just didn't. He's going back to the more the ambiguous Powell. He didn't really give any. The SEP was there, but the SEP can change. It was a welcome response. You see what I'm saying? He welcomed everything, but he's saying it was expected and then it doesn't change much. But then at the moments he could have been very hawkish, he wasn't. If you notice that, that's the thing where, you know, you probably got a little bit fooled. I know I did. On some, I'm like, wait a minute, how come he was saying some hawkish things, but then he would reiterate it or he would add it with something a little bit more neutral there. So I think we're going to get some volatility here. I think someone said it earlier in the chat, and I kind of agree with it, just in the nature of, you know, he's kind of giving credibility to the Fed. Because, like, every single thing he said was not, like, it was not bearish or bullish. Or, like, you know, it was expected. It was expected. We're not going to move anything just yet, but it was expected. You know what I'm saying? So, very, very interesting. Overall, decently hawkish press conference combined with a hawkish Fed meeting, says Bloomberg. Powell repeats he doesn't see the Fed cutting rates until policymakers are confident. Again, you don't have an answer from that. But then again, there was stuff where he acknowledged the welcomeness. Which one was it? It was Michael McKeon, the other question that brought it up there. No, I think just volatile, man. Volatile as hell. But I think it's still a hawkish tilt. I'm disappointed I didn't hold the other ES, but I'll hold one for anything else. Taking pain on the NASDAQ, but I am confident in I would rather be long on the bonds then and see. I mean, either way, if we lose big on the bonds, then I'm assuming the NASDAQ will come out, but if not, I think if anything goes bullish even further from here and people want to take it confidently, I think the outpacer would be on the bonds there. But my goodness, bro. My goodness. He just answered everything in the middle there. So we're going to see it. It's like a weird remix of September. Let's see. And then again, you're right at the 100-day right now, I believe, or the 200-day moving average. But it was kind of this. We just did the September move a little later. So if we don't hold here, we'll see coming into tomorrow. And then again, Friday is the big options expiration. So I think that one's going to be that we got to push a little till Friday. But I'm just going to hold what I have here now, up or down. Even though they're a little bit bigger, I'm still pretty I'm confident with the bonds backing it up. And then it just literally, I think Friday expiration is going to be the bigger move, or even coming into next week. Nah, but he ended it on a pretty good note for the year if you think about it. He left it. He said, listen, he gave himself flexibility. That's all. Powell is flexible. He didn't give you enough to read into what he's going to do. At this point, you have to either assume the real money is made if you know what he is going to do, or if you know where the data really is going to go further from here. That's it. That's all. Yeah, he ripped the tablecloth. There's flexibility. That's all he has right now. He didn't answer anything nothing backed him into a corner. The SEP is high enough. He raised inflation expectations while at the same time raising unemployment and terminal, while saying it's welcome and saying from rate cuts to anything, they are open, again, if they're confident. That's what he said, confidence. That's all he boiled it down to, was confidence. So it's all in the middle right now. And I think that gives you enough to where he didn't say, again, how he answered financial conditions, he wasn't even negative towards it, but he wasn't positive towards it. So I think he might just leave us here in the middle. Let's see where they wash out all the money on Friday, and then that's it. But I don't know. I think, again, I'm still leaning with a bearish tilt here. But, again, I do want caution for any upside. That's why I have some of the plays that I have. But I think we're right in the middle firmly. They're keeping rates, and the rate hikes were a little bit higher, but the message I got from his speech is that it doesn't even matter what the market is pricing in. That's it. I mean, clearly, so in a weird way, what's the point? Like, you know what I'm saying? I'm very shocked by that, because whether he preserved credibility or not, all that is telling me was that, yo, man, it doesn't, whatever they're confident in, the next set of data. But again, we don't really have a metric for what will make him confident, unless you want to go back to the jobs market, which he said is going to be strong. So very, very crazy. This one is, I don't know how this is going to even play out from here, except for we got to see which way the market ends up tilting. They're killing the premiums. That's the sad part about today. The sad part is the options getting clapped. Again, even some of the other ESs, I could have done better on that one, but as of now, though, it's at least you're getting the event risk out of the way now. So now the question is, you have low CPI, Powell welcomes it, but it doesn't really, he's acting as if he fully expected all of this to happen, which is kind of funny. The March puts. I'm talking about the dailies, the shorter term ones. The next week, even the puts there, puts and calls, even from the bottom. So even any of these lower calls there, they're getting total. Again, you're not moving as much though. This is right where we started, right at the VWAP and right at the 200-day. Oh my gosh, we only have 30 minutes left. Oh, what? Why did I think it was so much earlier? I thought we had like another hour. That was actually kind of long for a presser. Low key. Push everything till a holiday now. I'd be down to hold these plays until the holidays. Honestly, I wouldn't really be. Again, it would have been nice to save the ES money, but even then, I cut around the same level. So you could have made ES money back here, but it's not even like, it's not even that hot. Like it's very that one was a weird one. Powell just he put it in the middle, man. Where you're at the 50-yard line, but we don't know. Powell just was too ambiguous, but he has flexibility. So that is what you're gonna have to take in mind here. And then again, little diverge again with the bond and the NASDAQ play. You'll see what I'm talking about, but there is that potential there. And then again, I wonder how everybody else is going to do it. So when we get hotter data, markets may tilt towards pricing in 50. Yeah, soft. That's it. This fucked up the next rate hikes now too. That's what Chris Ansley's saying, but it makes a lot of sense. Just now think about it. The next set of data, whatever data comes out, what's going to happen? The bond markets are going to knee-jerk reaction because everyone's going to try to figure out if Powell is, they're going to try to figure out if he's confident or not. That's the word we're looking for now. So it feels like divided views among policymakers about how high they'll need to take the key rate with no specific guidance on February. Markets are going to be very volatile around important high-frequency indicators. Indeed, we've seen that lately with the big instant reactions to PPI and consumer price on yesterday. So, yeah, I would just volatility is your answer from here. I think Powell likes the market here, and he doesn't, and he wants the data to dictate where it goes from here. That's it. I think Powell likes in between 400 and 415. I think Powell is comfortable with that, and then as long as whatever the data shows now, that's it. You're gonna have a shit show on the bonds and Fed pricing every single data set from here on out. Now, that's all I'm getting out of this one. So let's see, what do we have tomorrow? We have retail sales tomorrow, Philly Fed business, long-term flows. You got PMIs on Friday. Then you have building permits and housing starts. Yeah, dude, he's a little shithead. He's a little shithead, man. I'm telling you. He's bringing us back to watch the data. I don't know. Just be careful on all of it now. Everything's going to be a lot more volatile. But then again, thankfully, you don't have too much data until the end of the year. But, like, do you get it? We're looking into January and their February, end of January meeting. But now you got to push it. He literally took all the pressure off in a way, but it's going to come as a result of the market. He doesn't care about the market. So the market could go to 430 or 380, and he's not going to give a shit because he's just going to base it all on the data. So I think anybody could take the hand right now, but he's not. He has flexibility. No matter what he says on February, you're not going to be like, oh, I hate you, Powell, because what did he tell you today? Nothing. All he told you is that, hey, if anything, we're expecting worse. We welcome it. Anything good we expected, anything bad we have covered. He's like how I'm playing the futures. That's it. He's playing both ways, and he's just going to dump it off at the data. That's it. He's playing the game how we're doing the futures. He has both ways. He was caught off sides initially. Now he's balancing it out. He said you could take it up however high or low. Whenever it happens, he's just going to claim victory and then take the other one off and then go from there, but then that's it. He's not. This is heightened volatility. I'm surprised. Premium should go through the roof right now, but at the end of the day, this mad volatility coming into today all the way until January 29th or January 31st. Inflation's still 7, but he said it's welcome, it's good and bad. He said 50-50, Habibi, 50-50. The Fed of the Fed, very smart, but we're on our own right now. He doesn't care about the markets. That's it, 380 to 430, and unless something else happens, and now every single event risk has just been increased, I would say. And then even the bonds, again, he just said your pricing doesn't matter. They just raised it on the bonds, but then they said we expected it, but then we still raised, and then we could go higher or lower. Very, very elaborate. He is stabilizing it, but that's why he's just, I mean, the markets are going to be volatile till then. That's it. So he bought himself another month. Let's see. Let's go into the schedule till the end of the year. So again, tomorrow, Empire Fed, retail sales, initial jobless claims tomorrow. So that could actually be something in the morning. Oh, that could be a big move, actually. Now that I'm looking at it, hold on. I skipped over that. Initial jobless claims in the morning. So now that might be as important borderline as the CPI, just given what he said today. So 5:30 tomorrow, initial jobless claims. And then Philly Fed, I don't think that'll hit as much. And then building permits next week, Conference Board of Consumer Confidence. And then you have core PCE on December 22nd. So then that will have another one. Then the leading index. And then Michigan Consumer Sentiment December 23rd. And then after Christmas, you get wholesale. And then end of the month, Chicago PMI. And then one more initial jobless claims. So what was the jobless claims last time? That's it now. Look towards jobless claims. That's it, but that's tomorrow morning. So whatever happened at the last one might go in line with it. But then again, he already raised the unemployment expectations. Jackass. Bro, I'm telling you. Bro, this one's a shit show. This is going to be a shit show. Yeah, it's dumb. It doesn't, bro, I'm telling you, we're going to get a lot of volatility now. You're going to get a lot of volatility, and now we're back to being at the mercy of the data. And then we will get other Fed comments, which could help or hurt us now that the blackout period is over. So that's another X factor that I would keep in mind, is that you will also get the other factor of all of that. Oh, poor Tesla. I know, man, right? Even, dude, look at the swings on Apple and NVIDIA. Oh, man, I don't know. We only have 30 minutes left here. Bro, you could still rock it right back up, or you're going to die and then continue it. But I'm telling you, this is now Powell. He did it artfully, but this one came at a cost. This one has a high cost of volatility for financial markets. So, again, you know how we've talked about Powell finding a way to thread the needle? I think he's doing it, but this time now it's not coming cheap. So now it's just like, that's it. The market is going to have a very big low. You're hitting the lows now of earlier. So, again, you're seeing how the positions are balancing out. The bonds are doing what I'm expecting here. So NASDAQ came back down and the bonds are holding. But let's see what happens here. But it doesn't matter. That's it. All of your positions are going to get flip-flopped by tomorrow morning, depending on what the jobless claims is. That's it now. That's the next one. And then PCE, I believe, coming into next week. Core PCE on the 22nd. I wish you a Merry Christmas. Yeah, next Thursday. So then tomorrow, jobless claims, and then that's it. Bring that in, and where's the 16th? You will get PMIs could have an effect, but I would say jobless claims tomorrow, big event, and then that's it. And then next week will be PCE alongside of another set of, of consumer sentiment. And we make up any losses with bad news. I mean, on the NASDAQ, we will. I mean, at the end of the day, I just cut the ES too early, but I like the position. I hope you see it. So it's like if we gap down, we'll make money on that. If it goes up, though, I mean, I think you're going to get, if you have enough to hold it out, I just think we're just going to have a very, very volatile market. So it's like we will be susceptible to much larger moves now on the data. Again, it's especially even now where the dollar is going to come back to play, I think. Where is that little asshole? I mean, a high number will be good. A low jobs number will be bad. That's it. But even the dollar's kind of subdued today. But watch out. Dollar might come back tomorrow or after the job. The dollars, don't write him off just yet now. So now the dollar, he's going to be able to do his thing potentially. But then again, watch even here too with the bonds. Good luck. Yeah, dollar, that's why, but maybe there might be a lag on that, but and then again, I like the bonds, and then if you have any short, I like holding the 10-year now just because it's just even with if there's any recession, if people freak out, it should be able to hold up, but like it doesn't even matter. That's it. All you're doing is just bet it. You could bet on the bonds, and there's nothing. It doesn't matter what the market price is in anymore. And then now every data release is going to flip the Zaza back and forth. And then now the question is, will the market, the only way we get out of volatility, is if you really get out of this idea that the Zaza if the Fed futures, if the market stops listening to the futures, if the bond futures, that's the only way the volatility dissipates now, because all he said is going to affect all of that stuff. And then now all the data will affect that stuff. So it's just now you need to get out of that. Otherwise, he did not, at least for me, he did not instill any confidence in anything the bond market is pricing in. So that's why it's like it's just a game. It's a game of chicken, right? You're playing a game of chicken with Powell, and then now he is not showing his hand, nor is he, communicating it in any of the ways that he has prior, which is crazy. That's it. I think we're getting close to it. Do you see what I'm saying? All of a sudden, Powell's not showing his hand, putting it in the middle, and we got what we wanted. So now it's like, that's it. He's claiming data-driven, but you're also welcome to report. And then he gave himself flexibility. That's it. The whole point is if he cuts and pivots, that's what people expected anyway. But now he just raised the expectations beforehand, and he said, yeah, it's welcome, but we expected it. So that's it. It's not. I think we're getting closer. I think in a weird way we are getting closer to the pivot, but I don't think he wants to communicate that. And that's where I think we're going to have this. And then now the data into the meantime, it's going to be about another month, dude. So one more month of everything crazy, and then that's it. And then we'll see what Powell says after the next set of data and all of that. But maybe he sticks with the same message, but I doubt it. But, we're going to have a very interesting month now of equities and bond correlations and all of that. You don't need a gap down. Again, jobless claims in the morning. That's it. Gap down or gap up won't. Technically, if that's what you mean, but all it is jobless claims data is at 5:30 Pacific, 1 hour before the bell. That's going to be everything. That right there will be your final move for Friday. And then, granted, you're going to have to deal with the wild expectations and the wild movements that we've already been seeing. Bro, it's just crazy. Powell. That was a weird, ambiguous, but that was a different. I think Powell is dude, we're playing chicken with Powell now. That's it. I bought the 10-year bonds. That's what I did. Again, you should be able to see it on screen /ZN. I was already holding them coming into it. I added, so I have 4 of them now, which is pretty good. Yeah, all daily calls, and the daily put for next week is break even, or the weekly put is break even. The calls are all negative though. So I got washed on those. I had to sell my ES out for a loss. I reopened up an ES, and now I'm down on that one, and I have a way bigger position on the NASDAQ, and I'm still down on that one, and then the bonds might kind of creep up. So I'm not going to walk away with a profitable day here, and now I'm at the mercy of tomorrow, but I'm totally comfortable holding this throughout this type of environment. It's going to be a shit show. That's it. So, pretty much don't panic if it goes against you. Take profits when they go up, and that's it. No, TLT is different than ZN. If the closest thing to ZN will be IEF. Yeah, I still have the Disney. I still have all the shares. Apple, Tesla, even the Uber. I'm still holding all those. That's why I'm focusing on the futures now. I'm comfortable with all of them. They have no preference. Again, just take a look since when I said it. I said short the NASDAQ, buy the bonds. You'll notice the bonds are holding up. If you got what I got out of it, even then, if you're worried about the SEP pricing in recession, any risk after there, the bonds could still keep coming down. And then if there's any data gets worse, there'll be a panic bid on the bond. So, and then guess what? Even if the NASDAQ rips and I lose money on that, the bonds will start squeezing again if they follow. But if the bonds go inverse, then we're going to have a problem. So then that shouldn't mean the NASDAQ should be up. So I think for a game of chicken, I'm down to play, and I'm down to hold those. That's what I want coming into it. But I have no preference. I want them paired up at the same time. Because essentially, if I lose on one, I'll make money on the other one till I get the next step on the game of chicken. But this is just, bro, Powell is playing a very interesting game right here now. I feel like he just raised the stakes. Bro, inflation just dropped twice in a row, and he said we knew that was going to happen. And then he said we knew it was going to happen. So we raised our projections by 75, and then we also think unemployment's going to go higher, but we still think the job market is strong. Dude, he's speaking insane right now. Compared to how much of an emphasis he put on prior about guiding the markets, this is in a weird way, he's kind of stepping away from guidance and then just throwing it all on the table. But I do think the stakes have been raised there by Powell. It's kind of crazy. Dude, he said we knew it. And then he said, yeah, but it's a welcome thing, but we're not confident. We knew it, but he said we're not confident because we knew it was going to happen. So since we knew it was going to happen, we can't have confidence that we're going to do what we told you we were going to do. He did say inflation is still high, but he added, it's just weird. He gave you both. He gave all of it all at the same time. That's it. He's talking and saying, no, he's not, though. He's just saying, that's it. The ball's in our court. Follow the data. And then he said and that was a big point. He said we're starting from a higher point, and there's a couple of things, but that's it. He said, get off my back. Look at the data. And then that's it. But he's not boxed into a corner. That's it. He's going to come into a difficult year of 2023. Everybody and their mother expects a difficult year next year. And guess what? The guy is not in a box, bro. Powell is free as can be. And he's going both ways. And he's just going to dump it once it's obvious. And then guess what? If he cuts it, who gives a shit? Because that's what you wanted, right? So who cares if he raises the expectations? Or again, if the data's bad, he's just going to be like, okay, well, yeah, we knew that was going to happen. That's why I kept it there. That's it, bro. Oh, it's crazy. This is a pretty small reaction, though, for the Fed, though. Let me show you. In a weird way, yesterday was the move. We have big expiration tomorrow, but now you have the jobless claims. But this is all data right now. He got out of the box. That's it. Powell is free. Powell is free as can be and is just going to play the data game now with us, and that's it. But he's no longer in a weird – bro, even inflation came down, and he said, I knew that was going to happen. He's trying to bring out the